ARK Innovation ETFs thrived in 2021, but they plummeted down to 50%, which drove most investors to sell the fund. Because of this, there's an underlying doubt about its potential, and many investors are shorting it. However, low prices mean that you can have bigger returns. And this is why the CEO of ARK Innovations, Cathie Wood, believes that the doubtful investors don't see that they're at a certain price point that can lead to a one-of-a-kind opportunity to hit it big in the stock market. Hey, welcome to Stock Market Mate. Today we'll talk ARK ETFs and whether you should consider buying it. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Price fluctuations are an interesting topic, but not everything that goes down will eventually bounce back. The legendary rise of fund company ARK Invest and its outspoken founder Cathie Wood was one of the most iconic success stories in 2020. However, 2021 proved itself to be the exact opposite. Because of this, Cathie Wood made two critical macroeconomic calls that may drastically affect the ETF. First, Wood predicted that there will be a very serious correction in commodity prices that may negatively affect the ETF. She added that she would be quote-unquote surprised if oil hit $70 again. Second, Wood expected a 15% compounded annual rate of return back when she thought the ETF was doing well. After the drop in prices last year, she envisioned a 25 to 30% return. To conclude, the fund is down an additional 20% year-to-date. The 9 ARK exchange-traded funds, which have a total of $23 billion in assets, all embody Wood's investing philosophy. Buy businesses with disruptive innovations that could revolutionize how people live and work. This is why the ETF also holds stocks like Tesla, digital payment company Square, and remote healthcare platform Teledoc Health. Wood is a firm believer in the exponential growth of these companies and has repeatedly set high price targets for them and bought more shares when prices have dropped, as she did with Robinhood Markets. Although ARK Innovation soared around 157% in 2020 and lost 25% in 2021, Wood's strategy may still yield great results in the long term. However, the lessons of the past year are worth the attention of all investors. But with the ARK ETF being 70% off its 52-week high, is it worth buying at the moment? We suggest that you should wait for the ETF to halt its current downtrend, form a new base, and then break out a past correct buy point to indicate the proper time to buy. However, here are a few ARK Invest stocks to look out for when it's time to buy. Teledoc. Teledoc's business naturally soared in 2020, when the pandemic made traditional in-person consultations with doctors, therapists, and other medical professionals much more challenging. Its ability to connect patients with online consultations was a win-win-win situation amid the COVID-19 crisis. Patients could receive the medical attention they needed from the safety of their homes. Medical specialists were able to generate incremental revenue by assisting patients who didn't have to be local. Insurance companies and employers were able to save on healthcare costs and improve the productivity of their employees. In its latest quarter, its revenue rose by 45% year-over-year, fueled largely by a 41% increase in virtual visits. The business model is holding up a lot better than the stock, and Wood may be holding out for a positive surprise when Teledoc reports first quarter results. Roku stock. Roku stock is trading more than 80% off its 52-week high amid sharp weakness in recent months. On April 28, Roku beat Wall Street's revenue target for the first quarter on better-than-expected advertising sales. Roku's bottom-line results matched estimates. Zoom Video stock. Zoom Video is the leader in modern enterprise video communications, with a cloud platform for video and audio conferencing, chat, and webinars across mobile, desktop, and room systems. On February 28, Zoom reported fiscal 2023 guidance that came in well below expectations, while January quarter profit topped estimates. Zoom is a mascot and a verb complementing the pandemic. People cannot wait to stop Zoom calls. The day is approaching. Zoom has no moat. Weaker demand for virtual meetings will hurt Zoom's growth. Shopify. Shopify is an e-tail giant. It gives merchants of all sizes the ability to sell through their own digital storefronts, but its services don't end there. The company also provides its clients with seamless integration into social media apps where fans and friends can promote products and services. It's hard to fathom the degree to which some of the mightiest growth stocks have fallen. Shopify stock has now lost 74% of its value since peaking just 5 months ago. The popular e-commerce platform is still growing, but its heady pace is slowing. Revenue went from soaring by 86% in 2020 to 57% growth last year. The deceleration is even more noticeable when one focuses on 2021's individual quarterly reports. However, Shopify will deliver fresh quarterly results on May 5th, and Wood could be trying to bulk up her position in the out-of-favor stock beforehand, in case this next report shows that the company is turning things around. Coinbase stock. Cryptocurrency exchange Coinbase debuted on April 14, 2021, pricing at $250 a share. Coinbase stock closed its first day of trading $328.28, up 31.3%. for a valuation of $87.3 billion. Coin stock is trading about 80% off its 52-week high. Coin shares are sharply below their 50-day and long-term 200-day benchmarks. The large stake in Coinbase represents another one of the ARK Invest stocks that offer more exposure to cryptocurrencies. The cryptocurrency craze is not going away. The Fed's claims of rate hikes have yet to materialize. Coinbase is among Bitcoin-related stocks investors should consider. Twilio. The next time you're waiting for a delivery driver to show up with your chicken tikka masala, recognize that when the delivery app lets you know your food has arrived, you can probably thank Twilio for the notification. Twilio is the top dog when it comes to in-app communications. Many leading developers lean on it to provide two-way communication options that can be accessed without having to leave their mobile applications. It's a booming business. Revenue climbed 54% in the company's latest quarter. Acquisitions are padding that growth, but even if you back out of those purchases, as well as the 2020 bump in election season revenue, it has achieved a respectable organic growth rate of 39%. Twilio is another former market darling that has been pummeled in recent months. The stock has fallen by 72% since hitting an all-time high in February 2021. A combination of slowing organic revenue growth, a lack of profitability, and shrinking valuation multiples are weighing on Twilio. However, it still serves a critical role in making your smartphone smarter, and you don't want to be against that trend. Block stock. Block is a digital payment and cryptocurrency leader. Block stock is about 70% off its 52-week high and sharply below the 200-day moving average. According to IBD Stock Checkup, Block stock shows a 41 out of a perfect 99 IBD composite rating. The IBD composite rating helps investors easily measure the quality of a stock's fundamental and technical metrics. On May 6, the company reported March quarter earnings, revenue, operating profit, and gross payment volume that missed analyst estimates amid lowered expectations. Tesla Incorporated. They say that Tesla is one of the biggest ARK Invest stocks, holding over a 9.5% weighting in the ARK ETF portfolio. In mid-April, ARK Invest unveiled its 2026 price target on Tesla stock of $4,600 a share. Tesla stock skidded 5% on May this year. TSLA shares are forming a cup with handle with a 1,152.97 buy point. Shares are more than 35% off their 52-week high. Skeptics who still question Tesla's moat in software, infrastructure, and first-to-market advantages will disagree that Tesla is good. Although ARK set a $3,000 price target, it sells small positions daily. Although ARK ETFs have faced a significant challenging year in 2021, the aforementioned stocks continue to be strong growth stocks, cranking out impressive double-digit percentage revenue gains. Wood seems to have the right idea here. However, as investors, what can we learn from ARK's recent downfall? For one, you need to assess your risk tolerance. Concentrated and volatile funds like ARK's aren't for everyone, even if they believe in innovation. Investors need to trust the manager's skill to pick the winners in these quickly evolving industries and have the stomach, patience, and financial flexibility to hold through difficult times, which even the most talented stockpilers will encounter. More importantly, these funds should never make up the majority of a portfolio. They're a complement to diversified core holdings. According to Ryan Jacob, the innovation companies are early in the business lines and a lot of them don't have any earnings today, so their valuations are always very subjective. He adds that there will be periods when these stocks come in and out of favor, and last year was just a microcosm that saw both ends at extreme. And that's about it for today's video. If you found this content helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!